they're paying.
Let's talk markets.
Who wants to be in this,
Mess of a.
Yeah, exactly.
Mess of a Washington. Markets still marching higher. All three major indices closing at all-time highs. Joining us right now is Michael Tyler. He is the Chief Investment Officer at Eastern Bank Wealth Management. Also, Mark Lucchini. He is the Chief Investment Strategist at Janney Montgomery Scott. I've been, Joe every morning says to me.
Yeah, I do.
Every morning says, there was supposed to be a pullback. When was the pullback?
You've been calling for it every.
No, but I
every
asked
tenth, every basis point.
Every
basis
question,
point. Right.
Everybody. This goes back to that phrase you also hate. As the train left the station, everyone always worried as the train left the station. Is there going to be a pullback? What's happening? This is what everyone's waiting. It
wasn't even when we first started talking about it. The train wasn't even in Philadelphia out of Newark. It was in that stop before Philadelphia.
Okay, Mark, where's the train right now?
I think the train has left the station, but it doesn't mean that it might not go back for some repairs. I like you, I think this elusive correction here remains front and center in terms of what the market is ripe to experience here. I mean, if you think about it, the market's bid on and bought about every piece of good news that could possibly come out of the administration and or economically. And I think we're ripe for some disappointment on either front. One, on the economic front, we see the Citigroup U.S. Economic Surprise Index breaching a level of 50, which is done in the past, but it typically doesn't stay above that level for too long. And that doesn't necessarily mean we see bad economic news, just comparatively softer. The other side of it is we've bid on deregulation and corporate tax reform, nothing to do with trade, nothing to do with protectionistic policies, nothing to do with the strength of the dollar as a consequence of a border adjustment tax. So I think that what we're going to see is some pullback, some retracement of these gains, not necessarily deep or long in duration,
Mark,
but something that restores some values.
Mark, I want to get over to Michael, but I do want to ask you this. So to the degree that you think there is a pullback, what kind of premium is in the market based on the expectations of what may or may not happen in Washington?
In my view, Andrew, it's something on the order of 5 to 10%. I think that, we're looking at almost now 18 times forward earnings based upon where estimates are for the remainder of this year and even maybe baking in some of the corporate tax reform benefits. And that seems a little bit rich to me. So I think peeling it back 5 to 10 would be, I think, rational and therefore restore some value that would make equities, given the economic validation, I do expect to see appear more appealing.
Did you miss the entire 13%? Did you ever say after the election, buy this with both hands, or have you been saying this the entire time?
No, we've been saying stay long, but stay tuned.
So when did you say pullback is imminent and don't buy it? When did that start? Today?
No, Joe, we've been on board with that thesis really over the last couple of months. We've had that double-digit move really since the election into the end of the year, beginning of January.
You've been wrong for 2 months on looking for a pullback. So
We've been early.
Okay. All right.
Okay, Michael, is Mark right or wrong?
Well, he's been wrong for 2 months.
Sooner or later, pullback sooner or later, it's inevitable. But let's face it, the market has not had a single down 1% day since the election. It's remarkable how steady this climb has been. And yeah, it's pricing in a lot of good news. But you know what? You have to stay invested. We've been long. We've been overweight stocks since before the election. We're staying that way. We know that, yeah, sooner or later there'll be a dip, and we'd like to buy that dip because the underlying fundamentals are fine. The things that I would be worried about are longer term in nature. The first couple of quarters of this year, we're going to have really easy earnings comparisons because, among other things, oil is twice the price it was a year ago. So I think that the earnings basis for the stock market is fine, and that's going to keep us going for a while. But comparisons get tougher in the second half of this year and into next year. That may be a headwind. Some of the issues that Mark raised in terms of the politics of when things happen, whether they happen exactly the way they're supposed to, those could also cause a pullback somewhere along the line. And frankly, the immigration and trade issues that are dominating the political headlines potentially can have very negative repercussions for the stock market because they could really be very negative for GDP growth and for corporate earnings down the road.
Okay, so, Michael, if you're right, though, what are you supposed to do about it?
Stay invested. You really can't afford to be out of the market. Nobody is a perfect market timer. And if you stay invested, but you ride through the down blips, you'll make it back up fairly quickly. The underlying strength of the economy is pretty good. We're looking at home prices. We're looking at construction. We're looking at business investment starting to pick up finally. The consumer is very strong. So there's no reason not to be fully invested right now. But pay attention, as Mark said, to some of the longer-term issues, because that's where there is potentially going to be problems down the road. But for right now, got to stay invested.
Michael, what would be a signal to you, a sign that it is not time to be fully invested? All of a sudden, the situation looks different.
Well, I think, among other things, a blow-off in price. In other words, a real speculative bubble emerging in price, which we have not seen. 17, 18 times earnings is not ridiculous by any stretch. But certainly that's one issue. If we start seeing some major changes in tax policy coming through that we don't fully understand, that could potentially be cause for a short-term sell-off. And I think longer term, we really have to be concerned about, is the Fed going to act more quickly than people anticipate? We get 2 rate hikes this year, May or June, and then again in December. People are fine. You get 3 or 4, I don't think it's going to happen, but if it does, we have to be really careful.
Okay, we're going to leave it there. Mark and Michael, thank you guys.
Thank you.
Appreciate it.
In any market, they're really the 2 decisions you have. You either